Hello, my name is Elliot Gu. I'm the editor of Personal Finance as well as the Energy Strategist and co-editor of MLP Profits. Today I want to talk a little bit about the big news item on the radar screen today, which is third quarter earnings reports. More than half of S&P 500 companies have already reported their earnings, and most of the companies in my coverage universe in energy and also more broadly in personal finance have already reported. Broadly speaking, it's been a pretty good earnings season. Two things to keep an eye on. One is that more than 80% of companies reporting to date have beaten their earnings expectations going into the quarter. Of course, those expectations were based on analyst forecasts, but that's actually a little bit more impressive than it might seem at first. First of all, that's a very high percentage. And secondly, a lot of analysts boosted their forecasts for companies after a pretty strong second quarter earnings season. So they're actually beating some pretty aggressive forecasts on some cases. The other thing was that in the second quarter earnings season back in July and August, one of the main sort of bearish talking points about earnings season was that the earnings were generated primarily by cost cutting. In other words, companies laying off workers, companies being able to source their raw materials more effectively, just efficiency gains. And that really lowers their costs, allows them to report higher profits, but doesn't reflect underlying demand. In other words, sales, actual demand for their products or services wasn't growing. That's not really been the case in the third quarter. In the second quarter, only around half the companies reporting actually beat their revenue or sales estimates going into the quarter. This quarter, it's actually closer to about 2/3 or even a little higher at the moment. That's actually a very good sign. That's actually a sign that, at least in some sectors of the economy, we're seeing actual demand growth, final demand growth. Really a couple of sectors to keep an eye on there. One is technology. Technology really stands out in my view. Something like 94% of technology firms reporting earnings to date have beaten their earnings expectations. And a much larger than average percentage have also beaten their sales expectations. At the moment, it's around 88% of S&P 500 technology companies have actually beaten their revenue estimates going into the quarter. So that's actually showing some pretty impressive growth year over year as well in some cases. For example, Google reported a few weeks ago actually showed year over year growth in their core business, which is click advertising. The other point to note about a lot of the sectors showing solid earnings and sales growth is a lot of that growth is not coming from the United States. A lot of that growth is coming from overseas. In particular, we're seeing an awful lot of growth in a lot of sectors from Asia Pacific. China did see somewhat of a downturn at the end of last year, economically wise. However, they were really the first big country to really bounce back from the 2008, 2009, early 2009 sort of economic collapse. And that's really starting to show up in actual earnings reports from those companies. And one of the things you got to remember is that steadily over the last 20 years, the percentage of earnings of S&P 500 companies coming from outside the U.S. has grown very steadily. So there are a lot of companies that get the vast majority of their earnings from outside the country. One of the key sectors for that, of course, is technology. Another area I want to talk a little bit about more specifically is energy. We saw a lot of the energy stocks, or several of the big energy firms reporting, actually sell off a little bit after releasing earnings. And a lot of times when that happens, you'll see websites and news channels, the major television channels that report on business, say, there was something in the report that was disappointing to investors, and that's why the stock is selling off after a call. Typically, the media generally, journalists really try to look for reasons why stuff happened after the fact. But the reality is, if you look at a lot of these stocks, most of them ran up very aggressively in price from late September, early October, through about the 20th or 23rd of the month. And they're really just selling off a little bit after those big run-ups. So a lot of these companies really said better than expected things on a lot of fronts, both on the revenue side and on the earnings side. Reported a real uptick in activity in a lot of energy-related sectors. Sold off a little bit after the report, mainly because traders are just simply taking a little bit of money off the table after what's in some cases a 30% run-up in a matter of just a couple of weeks. Some of the big points out there that I saw from the calls that I think are going to be important trends going forward. One, on the oil front, I'm actually looking for oil prices to reach new all-time highs by 2011. And when I say that, I mean sometime in 2011. I've been looking for oil prices to touch $80 this year, pretty much the whole year. We've hit that target. Next year I've been looking for prices to get up over $100 a barrel. That actually looks like a pretty conservative target at the moment. And now I'm also looking for, I think, new highs in oil prices. In other words, over that $150 barrel area by 2011. The reason I say that is that we're seeing a lot of nervousness on the part of companies that actually produce oil. The reason that they're nervous is they don't really want to increase their spending on exploration and development because of the recent memory of last year's collapse. In 2008, when oil prices were really ramping up, a lot of these companies increased their budgets, wanted to do more projects, more exploration work, more development work, because oil prices were very high and they wanted to maximize their production. When oil prices collapsed into the 30s at the end of 2008 and early 2009, a lot of these companies had to severely slash their CapEx budgets and were really more worried about hoarding cash, access to credit, than they were about growth and expansion and production. So the very near-term memory of that big drop-off in oil prices makes them reluctant to increase their capital spending, even though oil prices are back up in the upper 70s, low 80s, which is a very economic region for oil to be trading for most of these companies. So I think they're going to actually be a little slower than expected in terms of ramping up their exploration development work. I think you're not going to see a big jump in spending from the big companies. Your big integrated oil companies like Exxon, et cetera, and your big national oil companies like Saudi Aramco in Saudi Arabia and Petrobras in Brazil. You're not going to see a humongous uptick in a lot of these companies' CapEx spending beyond what they've already announced until the second half of 2010. And as a result of that, we're probably going to see non-OPEC oil production trend lower than expected into the first half of next year, and most likely throughout all of 2010. I think it's going to come in a little bit under expectations because these companies just aren't putting the money into these fields that they need to ensure that they have actual production growth. As a result, I think the oil market is going to tighten up a lot faster than the market expects right now. And I think you're going to really start to see that happen very aggressively as we move into 2010. Already, over the last couple of weeks, we've had some larger than expected drawdowns in U.S. gasoline, oil, and distillate inventories. I think that's a trend that's going to continue. But remember, the real story is outside the U.S. That's where all the demand growth is coming from. And if the supply isn't there to meet that demand, you're going to see oil prices again spike up just like they did in the summer of 2008. And I think that's going to happen between now and sometime in 2011.